Hello everyone, welcome to another episode of Fundamental Analysis. Today we'll talk about fundamental analysis and its history. With you today is Amr Al-Alfi, and we'll take a look back at what fundamental analysis is and how it started historically. The importance of this fundamental analysis actually started to come about more recently, but it's been there for a long time, since the beginning of humankind. Fundamental analysis is basically how we can calculate the cost-benefit analysis of everything, any decision you're going to be making, whether it's going to be a good or bad decision. You decide based on how beneficial it is and what's the cost related to that decision. It is an old basic theory, but it is the basis of fundamental analysis when you make any investment decision, to make sure that it is helping you and trying to understand the ramifications of this decision that you'll be making. Over the coming episodes, we'll talk about more about fundamental analysis, but today let's talk about the history of fundamental analysis. The importance of fundamental analysis usually comes about whenever there is a problem around the world, whenever there is a crisis. And we've had several crises over the past history, and this is why we call fundamental analysis. It is fundamental, it is basic, and we have to go back to basics to understand what's going on. So let's take a look at history and look at this rose or this flower. It's basically called tulip. This is the tulip flower, and around the 16th century in the Netherlands, there was people who were actually interested in acquiring this type of tulip flower, and the reason they've actually wanted to acquire this flower is the way it looks. As you can see there, it looks a bit different. It's not really totally red. There's been a virus that's actually infected this flower, and which made it so special that everyone wanted to acquire this tulip. Some people even sold their own properties to buy this tulip. And this is what we call the tulip mania, because this is the time that everyone around the world, or around the Netherlands rather, were actually buying the tulip and bidding its price higher and higher and higher. So basically, this is the definition of a bubble. It is the definition of a price bubble. Definitely our friends who are technical analysts can tell us more about price bubbles, but the reason that we have price bubbles is because we don't really go back to fundamentals. We do not understand what's going on. It is basically what's going on every other decade whenever the human nature comes in. Let's take a look at another example, and this is called the South Sea Company. This is the share price of this company. It wasn't a UK company at the time when the United Kingdom or Britain at that time had some war down there in the South Sea, basically where the Atlantic or the Pacific Ocean is. And the UK government at the time gave this company, the South Sea Company, a monopoly over trade that's going on in that part of the world, basically on the sea. And this is why it's called South Sea Company. So it was getting this monopoly. So basically, if you have a monopoly, you're going to be taking or making lots of profits if trade starts kicking in. And this is what the story was. So the company started building its story by making new capital increases every now and then, as you can look at this chart. And the bottom, on the x-axis, you can see the dates, and on the y-axis you see the price of this company's shares. As you can see, the shares started and began to increase in price over time, from just over 100 pounds all the way to be trading at 900, and this only in probably 6 months. So why is everyone buying this company? Because basically everyone was buying the company because they know for some certainty that this price will actually continue to go even higher, and this would be a good way to capitalize on this euphoria and sell at a higher price, then garner a huge gain. However, as long as time goes by, the company did not really start to make any profits or any trade as it was supposed to do, and just started, investors started to realize that the company is not performing anymore, and the company is not really delivering any cash flow. And then this is what happened. The company started falling. The share price started to fall down. One of these investors who actually invested in this company was Isaac Newton, the famous scientist. He's actually lost a lot of money in this company, to the point that he did not even want to hear this company's name at any meeting he had with anyone. He said that he can calculate the speed of stars in the sky, but he cannot recalculate the madness of people. And this is basically what we call psychology. It is behavioral finance. So we need to understand actually what happened. Why did the stock price go up so much, and why did it go down by that much in such a short period of time? For this time, we'll just close our episode for the time being, but we will talk about fundamental analysis in our upcoming episodes very soon, in the coming few days. Thank you very much for listening, and hope you've enjoyed this episode, and we'll talk more about fundamental analysis in our next episode very soon. This was Amr Al-Alfi. Thank you very much for listening.